Hi folks, welcome back to Murthy Finance Academy. Today, the second company which we are going to discuss from the auto ancillary space is none other than Sona BLW Precision Forgings Limited. So previously, I already made videos on Recall, SJS Enterprises, Lumax Auto, Lumax Tex. If you haven't watched out them, please do watch them, which are already live on the channel. Okay, but before we proceed, a quick disclaimer: I'm not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. Now, let us start. Sona Comstar has successfully evolved from a legacy component manufacturer into a sophisticated systems provider, positioning itself as a primary architect within the EPIC, Electric Personalized Intelligent Connected Mobility Framework. By integrating mechanical engineering with power electronics and embedded software, the company has transcended iron bending to deliver high value subsystems. This strategic pivot allows them to capture a larger share of the bill of materials in the next generation of vehicles. So, for the 9 months fiscal year 2026, the company's core business identities are core products, which are nothing but differential gears, assemblies, starter motors, traction motors, integrated controllers, sensors, etc. So it is having a global market share in differential gear segment at 8.7%. And if you see its revenue mix as per market segment, from passenger vehicles alone, it will generate nearly 49% of the revenue. And from geography mix, if you see, North America is a dominant factor wherein it is generating nearly 49% of the revenue. So what separates Sona from traditional foreign players is their systems approach. Rather than selling standalone components, they offer integrated solutions like integrated motor controllers and HVE axles. This creates significant technical moats and high switching costs for OEMs. However, this high-tech model is currently navigating a complex global environment where rapid growth is meeting temporary margin headwinds. So the global auto ancillary landscape is currently defined by the friction between ICE internal combustion engine legacy and the mandatory acceleration of EVs and ADAS. While Western market shows sign of EV fatigue, the regulatory landscape in India is creating a massive mandatory market for Sona's new sensing and perception business. So the ADAS catalyst, new Indian ADAS regulations are no longer optional. The codes like AS 186, AS 187, AS 162, and AS 188 are no longer optional. These codes, which align with global standards like UNECE 151, which is nothing blind spot information, and UNECE 159 is nothing but moving off information, require commercial vehicles to adopt sophisticated radar and vision systems. Sona, through its Nobilic acquisition, is uniquely positioned to meet these standards. So Sona is one of a few automotive radar manufacturers in India following the January 2026 launch of its Chennai SMT surface mount technology line. This domestic manufacturing capability provides a localized cost advantage that importers cannot match. This shift towards high-tech sensing helps offset regional macro volatility and creates a high margin revenue stream. Geographic diversification is Sona's primary hedge against the cyclicality of the Indian market. This quarter confirmed a massive structural shift in where Sona earns its keep. North America momentum. The 9 months fiscal year 2026 mix shows North America contributing 49% of revenue, a local. This reflects a radical jump from the 29% level seen in fiscal year 2025. This reflects the scale of major EV program in US. Also, it's India moderation. India share has cooled down to 28% from 41% in fiscal 2025, signaling that while the base is stable, the hyper growth is currently an export story. Europe consistency. Europe remains a steady 18%, providing a stable baseline despite regional economic jitters. So, EV program traction. Sona continues to win big, boasting 64 EV programs across 33 customers as of Q3 fiscal 2026. While the company added two new programs this quarter, the so what is a decline in 3% year-on-year decline in BEV revenue. This suggests that while the order book is growing, the execution is currently in a transition lull as older programs mature and the new ones await full ramp up. So the top line growth remains stellar, but the ruthless reality is that margins are under pressure due to an adverse product mix. So for fiscal year Q3 fiscal year 2026, the company generated revenue of nearly 12,085 million rupees, which is a 39% year-on-year change. And EBITDA also grew by 30%, and adjusted PAT also grew by 20%. While EBITDA margin dipped to 25.2% from 27%, is directly attributable to the 3% year-on-year decline in BEV revenue, Sona's highest margin segment. When the high margin EV part sells less, the overall margin profile also suffers. This is likely a cyclical dip, but it proves Sona is not yet immune to the global EV slowdown. So Sona remains a net cash fortress with a net debt to EBITDA of 1.04. However, investors must address the screen or dot in figures like working capital days have spiked to 118 days from 76.5. This spike is significant. It indicates that aggressive global expansion is tying up in cash in inventory and receivables, slowing down the cash conversion cycle. So management also highlighted a 301 million one-time impact due to new labor code. So while we adjust for this in the PAT, the cash impact is real. Investors must monitor if cash flow from operations can keep pace with accounting profits in fiscal year 2027. Sales are up a massive 39%, but we are earning less on every rupee because the fancy high margin EV parts are seeing a temporary sales dip. The company is debt free, but its money is getting stuck in the business longer with 118 days than it used to. So the company's also net order book is around 235 billion, a staggering of 6.8 times of fiscal year 2025 revenue. And its EV share of order book is nearly 71%. And the company's asset turnover also moderated at 3, while it is 3.4 in March 2025. And ROCE and ROE are also around 15.6% and 13% respectively. So the drop from 28% levels in March 2024 to 13% is a classic investment hangover. So Sora has deployed massive capital for noble sensing and railway acquisitions. This capital is now sitting on the balance sheet but hasn't reached the high utilization phase yet. The market is effectively waiting for these investments to start sweating. So management led by Vivek Vikram Singh, MD and Group CEO, and Rohit Nanda, Group CFO, remains focused on the recovery of BEV revenue. So management's guidance has consistently emphasized the move towards subsystems. The showcase of AMR, Autonomous Mobile Robot Platform, and EOTL, Gearbox at CES 2026 validates this. They are successfully diversifying into non-auto segments, which is a critical long-term hedge. So the Novelic integration is the secret sauce. The upcoming mass production of the 60 gigahertz in-cabin radar in H2 current year 2026 signals a shift toward AI-driven software revenue. So the bosses Vivek and Rohit are staying the course. They are spending on robots and flying taxis to ensure they aren't just a car parts company. Management credibility is high because they are hitting their tech milestones even if the current market is a bit slow. So if you Sona is often labeled as expensive, but a deeper look at PEG, price to earnings growth ratio, suggests otherwise. So the company's current PE ratio is nearly around 47 to 49, with ROCE of around 17 to 18% and 5-year profit CAGR of nearly 31.5%. So with a PE of 47 times and 5-year profit CAGR of 31.5%, Sona's PEG ratio comes to nearly around 1.5%. For a high moat non-cash tech leader, this is arguably more attractive than Bharat Ford's 75 times of PE. So the stock looks fairly priced rather than cheap. You are paying for quality and a 235 billion order book. It's a classic growth at reasonable price play in a very expensive Indian market. So some key red flags in this company are a major red flag is the 25.5% decrease in promoter holding over 3 years. In Dalal Street, such significant dilution by founders often caps the upside as it raises questions about whether the promoters feel the peak valuation has been reached. Second is concentration risk. 38% of revenue is tied to BEVs, which saw a 3% decline this quarter. Sona is a hostage to global EV adoption rate. Third is working capital spike. The move to 118 days is a drain on liquidity. If this doesn't reverse, it will impact future ROE. And the fourth one is global macro with 49% revenue now in North America. Any US recession or trade tariff shift is a direct hit to Sona's top line. So, what are its key strengths if you ask me? It's 235 billion order book, 8.7% global gear market share, and net cash balance sheet are its key strengths. Coming to weaknesses, declining ROE trend, high working capital days, and softness in BEV revenue are some of its weaknesses. Coming to opportunities, Indian ADAS regulations, 13 billion railway order book, and 60 gigahertz radar mass production in H2 of current year 2026 could be act as opportunities. Coming to threats, further promoter stake dilution, global BEV slowdown in North America and Europe, and adverse product mix affecting margins. So some key monitorables to be watched for are BEV revenue pivot. We need to see this move from -3% back to plus 15 to 20%. Chennai SMT capacity utilization, the ramp up speed here will dictate fiscal year 2027 ADAS margins and working capital days, whether the target reduction from 118 days back towards the 80-day historical average and EBITDA margin recovery, a return to the 27% value range as the product mix stabilizes. And the fifth one is railway execution status of 13 billion diversification book. And the sixth one is promoter holding stability. Any further selling will be a major sentiment dampener. So, as a conclusion, Sona Comstar is currently in a high stakes digestion phase. It is absorbing the capital cost of Novelik and railway business while navigating a temporary lull in global EV demand. However, delivering 39% revenue growth and maintaining a 25.2% margin during an adverse mix cycle in an incredible display of operational resilience. The 23.5 billion order book provides the ultimate visibility, and the 13 billion railway book offers a vital hedge against EV volatility. While the promoter selling and ROE compression require a watchful eye, the technical moats Sona is building in ADAS and robotics suggest it remains a global mobility leader in the making. The re-rating catalyst will be the moment BEV revenues and margins pivot back to their historical growth trajectory. Hope you like this video. If you do like this video, please do like, share, subscribe, and comment to Murthy Finance Academy. If you have any doubts, please do ask them in comments. I will try to answer them. Also, I'm posting some updates on interesting companies in community post app. Please do watch them as well. None of them are buy or sell recommendations, just purely for educational purpose. Okay. If you like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.